while paper gets pushed down, China was vacuuming up physical supply at every available shelf on the planet like it's never been seen before. And we saw 100 tons of silver leave the Shanghai market in the period of a week. So big money is standing for delivery across the globe. I'll say this, to me, the one thing that the media has missed more than anything, they've talked about price, they've talked about all the negative reasons why gold didn't, shine in a period of war and all of these things to make it look bad. Silver, the devil's metal, they call it, overbought, fundamentals look bad. It's another 1980, it's another 2011. The one thing that they've missed more than anything is who the hell is standing for delivery to the tune of billions and billions and billions and billions every single month for about a year and a half now.
The silver market is experiencing extreme volatility and supply tightness, with significant delivery activity and price fluctuations driven by Western and global market dynamics. AndrewMaguire and Andy Schectman are well-known voices in the precious metals industry, both focusing on gold and silver markets. In this video, AndrewMaguire explains that the current movement in gold and silver marks a major inflection point, similar to past events like 2008 and 2013. However, unlike those periods that took years to unfold, this correction has happened very quickly, making it more intense and compressed in nature. Andy Schectman responds by saying that the recent drop in prices does not reflect weak fundamentals. Instead, he describes it as a structural correction, caused by factors like sharp increases in margin requirements and forced selling from leveraged ETF positions, which triggered a chain reaction of liquidation in the market. In his analysis, Schectman emphasizes that while paper prices were falling, physical demand has been strong. Countries like China have been importing record amounts of silver, and large volumes of metal are being withdrawn from exchanges, indicating that major players are actively accumulating real assets. Schectman suggests that big institutions and possibly central entities are positioning themselves by acquiring physical metal, and that this hidden accumulation could fuel the next major upward move in gold and silver. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Andy Schectman's recent interview with AndrewMaguire.
This is the kind of inflection point. We saw this, I think, the last time we saw anything of this scale, and it took years to resolve, as opposed to just really 4 months worth of correction, was back in the 2013, when we saw the 2008, we saw an initial very similar initial dollar scramble for dollars, and we see the price come down a bit, and then off it goes, and China buys, and everyone's buying, and then 2013, I remember publishing the ABN AMRO letter on the 1st of April. Which on the end of actually March of 2013. And if you remember, that was the time when the PPT, the plunge protection team, came in after a meeting with the presidential meeting with all the bullion banks and smacked it down. It was 4 years of downside. We've just had this done in a 4-month period of the same kind of scale. Tell us what you're seeing, Andy. I can't wait to hear.
Well, I mean, I think that the gold and silver coming down, Andrew, changes nothing. It's the same game that's always been played. The paper markets push price around and strong hands are accumulating the real metal. I don't think lower prices are weakness. To me, they're an opportunity this time. And I mean that sincerely, because this is accumulation. This is positioning. There's a buyer for every seller, and the buyers of this panic are the smart money traders, the people that know the fundamentals haven't changed. And to me, this is only normal sediment reset to build a fuel for the next leg up. Let's talk about silver for a moment. We talk about this movement down, this correction, which the Bank of International Settlements came out and said, look, this move in their mind is structural, not fundamental. What does that mean? Well, they say that it had to do with the massive influx of metal running into the levered ETFs that all had to rebalance in January, along with the massive increase in margin requirements on the CME that went up over 300% in a month, specifically designed and targeted to squeeze the speculators. Had much more far-reaching effects into the retail industry and the refining industry here in the States. But what it really did is it absolutely blew up all of the speculators who had to post 300% more margin in a period of a month to keep their positions open. When they didn't, selling beget selling, beget selling, beget selling, beget selling, and bang, the price collapses. We see banks like JP Morgan covering at the very bottom. We see massive deliveries, not just on COMEX, LBMA, or Shanghai, but I think it's very interesting. Let's start with China. Bloomberg just reported that the Chinese custom data says that 790 tons of silver were imported by China in the first 2 months of the year. February alone, 470 tons, the highest monthly import volume ever recorded, while the price got its teeth kicked in. So while paper gets pushed down, China was vacuuming up physical supply at every available shelf on the planet like it's never been seen before. And we saw 100 tons of silver leave the Shanghai market in the period of a week. So big money is standing for delivery across the globe. We've seen in the last 6 months, 200 million ounces of silver in the registered category, September of 2025. 6 months later, we're right here and it's about 78 million. So over 120 million ounces have been drawn down in 6 months. Who's doing this? We look at February here in the States, which is a non-delivery month, right? You can take delivery, but not a primary delivery. Roughly 25 million ounces delivered on COMEX. One of the smaller deliveries we've seen in the last year and a half, but 160% of what deliveries could explain alone, roughly 38.5 million ounces, left COMEX. That's over 2 million pounds. Who is arranging the logistics for this? Who is putting all of those bars on semi-trucks and driving down the street with insurance and logistics, and where's it going? Is there a coincidence that it has been classified a critical mineral? I'm just saying. But we're seeing the same thing in gold too. Massive deliveries, huge deliveries. And to me, Andrew, price is just a tool of misdirection. Now, if I had to be completely honest, I feel that indeed this correction was completely structural because of the structured changes, not fundamental. And I also feel as though the banks that have been playing these games for a very long time realize, for whatever reason, that being on this side right now in a market where traders have now come to the conclusion that what the West has been doing is a way to control prices, and they figure the way to win the game is to stand for delivery across the globe. We see that, and it's almost as if they're trying to get on sides. And you look at what Ed Steer just said. He said the commercial banks right now have the lowest short position in history in silver. So could it be? Could the Economic Times be right that the banks in the United States are flip-flopping, trying to get net long, using these drawdowns with massive leverage that is very not organic, let's say, or what's happening with Jane Street and the theories behind that? Could it be that they were using these episodes to go long, to flush out the speculator, to flip-flop sentiment that was wickedly bullish for a while and now has fallen, to allow the fuel for the next leg up? And I'll say this, to me, the one thing that the media has missed more than anything, they've talked about price, they've talked about all the negative reasons why gold didn't, shine in a period of war, and all of these things to make it look bad. Silver, the devil's metal, they call it, overbought, fundamentals look bad. It's another 1980, it's another 2011. The one thing that they've missed more than anything is who the hell is standing for delivery to the tune of billions and billions and billions and billions every single month for about a year and a half now, and a lot of it now being loaded out of the exchanges. So to me, that's the only thing that matters. Everything else is a distraction. Everything else is noise. The most well-informed traders on the planet, starting with the central banks for years, as you and I have talked about, now moving to whoever the hell is doing it here in the United States, which I have felt for a long time was the Exchange Stabilization Fund, doing it on behalf of the Treasury for national security, therefore does not need congressional approval. But who's standing for delivery for literally billions every month?
During the interview, AndrewMaguire explains that the silver market, especially in London, is no longer reflecting a true price. He notes large buyers don't actually get metal at the official fixed price because deals are done privately, and the bigger the order, the higher the premium. This has shifted pressure onto COMEX, where physical delivery is still possible, but he notes growing difficulties in actually getting the metal out, possibly due to tighter controls and limited supply. Regarding physical silver demand, Andy Schectman underscores buyers are willing to pay much higher prices through alternative routes, highlighting strong demand, especially from China. Trust in Western pricing systems like COMEX and LBMA is declining due to delays and manipulation concerns, pushing countries toward alternatives such as BRICS exchanges. Recent news also supports this trend, showing extreme volatility in silver prices and strong demand from China driving premiums above Western benchmarks, while analysts warn of ongoing supply tightness and market stress. Let's jump into the interview.
And when you think about it, if you try and go buy silver in London at the LBMA, it's a bilaterally settled contract. Therefore, the reference price at the fix, forget it. It's nothing to do with that price at all, because now, and the bigger the size you want, the higher the premium. So essentially what that does is kind of put the COMEX in the crosshairs where you can actually load out some inventory. But I'm running into problems here, or my liquidity provider recently ran into a problem. They're saying, look, they don't want to let me have it. Essentially what they're saying is that because of export controls, all of a sudden now, if I'm a PBOC buyer or I'm or a foreign entity and I want to take that silver because I haven't got any and my inventories are at record lows and I want to restock, I go to the only source that I can actually physically load it out from should be the COMEX. But there's export controls. And I think it's leached down to the word on the street is, no, make them a price. So what our liquidity provider said happened to him was he was told, right, tell you what, here's your settlement price. It is whatever we can determine at the LBMA for a bilaterally settled price, which is plus the 8% for lease costs and one thing and another, and then the additional cost to ship it out. They still find it worth the arbitrage. You can't get it right out of the COMEX. So the arbitrage, whereas we've seen silver, Shanghai silver running around about a $10, 13% premium all the time to what's been going on consistently.
Months and months and months, yes.
Months and months and months. So now if you can't get it out of the COMEX, the price settlement that you're being cash settled for is enough to then go to the LBMA, force them to lease that bloody gold onto the market, which is about 8% in addition, plus the extra cost. And they're still doing it because they just need the silver. And even though the arbitrage has kind of been taken out of it, they need the silver and they're taking it. So this drain is under the radar going on big time and people don't get it.
Well, look at it the other way too. Okay, so the Chinese have the arbitrage at roughly 13%, whatever. Okay, but what people are missing on that too, and there's been a lot of question about it, and I'm pretty sure I'm right on this. I've tried to dig as deep as I could into it. There are a lot of people who are confused about the VAT tax on the importation. Mm-hmm. To my understanding, it is the recipient's responsibility to pay the VAT tax when it leaves the Shanghai Metals Exchange. So if a trader has the ability to deliver it to Shanghai, not only is Shanghai paying a 13% VIG, if you will, on the premium, but a pretty damn close to a 13% VAT tax as well when it leaves. They're willing to pay 26% above the Western benchmark price because that's how bad they want it. So, you look at it from a standpoint of what really is the price. And then you look at India saying, well, we're not going to even trust the Western price anymore. So let's set that aside for a moment. And then you look at the exchanges that are being built in the BRICS. They are going to build a BRICS metals exchange along with the BRICS grain exchange. And I love the comment that the gentleman who is in charge of the grain exchange made about a year ago when he said, look, we in the West, they don't produce as much grain as we do. They don't consume as much as we do, yet they control the price because it's controlled on COMEX. He said, but with the development of the BRICS grain exchange, that will change. Well, the same thing is happening here now. You will see things change when the Western price just is not looked at as something that can be trusted any longer. And trust is something that when you violate it over and over and over again, whether it be the shenanigans that have happened at the LME, or the shenanigans that have happened at the COMEX, or the shenanigans with the 8-week delivery delays on a T+1 settlement at the LBMA, and the glitches and all of the things we are seeing, the Western edifice, the Western system, in my mind, by those who understand it, is completely and totally trustless. And I do not think that the players that matter have any intention on allowing this system to go back to normal. They will do all they can to bleed it down as easily as they can and as orderly as they can. A lot of people say, well, why don't they just buy it all up? And the instant gratification syndrome that we have in this country, where everything is about now, from cryptocurrency to NVIDIA to Apple to gambling to betting on everything. It's all, I need it now. There is no grinding and hard work and laying the foundation anymore. So they dismiss ideas of a death by 1,000 paper cuts. So why don't they just buy it all right now? Well, they're buying it as much as they can across the globe. On every exchange, they are importing record amounts as the price is getting its teeth kicked in February. They're flying to China. China is flying to Mexico and South America to buy doré and concentrate at double what the West will, send it back and refine it themselves. Everything they are doing tells you they're playing the long game. And at some point, it just seems to me that the privilege that we have had in London and in the United States for all of these years, which has been abused, is understood by the rest of the world. And they are doing what they can to exploit it with things like a arbitrage event that normally would close out like that because the traders would fill it, to whatever they can do to play the game as long as possible, stand for delivery in any particular manner that they can, but not enough to break the system until the system breaks on its own. And I don't know, it just seems we're getting closer and closer and closer to it when you see all of these things like the rumors of Jane Street, where the rumor is, similar to what they did in India, that they went from roughly 40,000 shares and a month later have over 21 million shares of SLV, the largest holder. At the same time, they load up on options that profit if the price falls, collapse the price, make $1 gazillion on the options, lose on the stock price. But you wonder, a company like Jane Street, who's being sued by India, who loads up and is the largest holder of shares that is administered by JP Morgan, who paid the largest fine ever for manipulating the metals market, yet is still allowed to be the custodian of SLV, the world's largest silver trust. You have to wonder at some point, like Grant Williams' great video he did, things that make you go, And you look at this stuff, and how do you not go, like, how many times do we have to be poked in the eye before we start to say, does this system really, does it inspire any confidence? I don't know how you feel about that, Andrew. I'd love to know your opinion, because I look at this Western system as squandering so much in the way of trust, and now doing it right out in the open. I wonder how long before in countries like India start to do things across the board, where countries just start to give up totally on what the LBMA and what the COMEX have offered for all of these years and start doing it on their own.
By the beginning of 2026, the price had more than doubled, reaching $79. With such a steep increase, many investors are giving silver another look. But before you put your money into silver, it's important to understand ongoing scenario. Experts with BlackRock and JP Morgan agree that the outlook for silver remains strong, and its price will increase. By the end of 2026, experts predict silver's price will surpass $80 per ounce, and it could reach $100 per ounce by 2030. If physical demand keeps rising while trust in paper markets continues to fall, Are we approaching a moment where the true price of gold and silver finally breaks away from the system that has controlled it for decades? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.